Good day. I'm Dave.
And I'm Dave.
This is the OFFSITE
Insight
Podcast.
Today's episode is brought to you by the Creative Co-op. If you have any marketing or advertising needs, please reach out to Gino and the team at tcco.ca.
We're excited to bring Jonny from Primetime Financial Incorporated. Jonny's a financial advisor, but he's not giving us financial advice. Is that correct?
That's correct. What we're doing today is information. If you want advice, welcome you to come book a meeting. Happy to do that there. Our compliance team gets funky with us if we...
I don't want to get your compliance team mad at you.
No,
that's not my goal.
Christmas card at the end of the year, that's my contact with them, ideally.
And just so we can get it out of the way, how do people reach out to you? What's the best way to contact you?
Best way to reach out to me would be email Jonny@primetimefinancial.ca. It's .ca because we only operate in Canada.
Fantastic.
And yeah, I'd recommend that.
Amazing. Let's dive right in. What does Primetime Financial do?
You know, this is a really good question because we've been a part of the Home Builders Association for 26 or 28 years, something like that. So my boss's wife, they own Primetime Financial, the two of them. Okay. And she used to be the chief executive officer of the Home Builders Association. And so through that, we joined. A lot of people, when we meet them, they say, oh, so what kind of lending do you guys do? What kind of, how do you help builders secure loans? And so, well, that's not really what we do. We're in the personal finance space. So looking at individuals and business owners of Canadian, like corporations or, small business, and helping them make good choices based on the tools that we have available to us in Canada.
Okay. So could you walk us through a little bit about your process?
Yeah, definitely. So when it comes to, I guess there's two kind of buckets there, right? There's like the individual and there's the business owner. For the individual, there's a whole life of your financial journey. Kind of starts out with the kind of growth phase, right? You got your money and you start putting it away so that when it comes time to stop trading your time for money and you can start using your time for what you want, you have enough assets there that are going to pay for your living as you go, right? So there's accumulation, and then there's the kind of accumulation size, two sides of the same coin. And a lot of people think what we do is we pick the best stocks for you, and that's not really what it is. Although there is a key part of like investor psychology. Do you guys invest at all?
Yep.
Yeah. So what do they say about investing? They say buy low and sell high, right? That's the dream. That's the dream, right? Yeah. But it doesn't always work out that way. Mm-hmm. I read this study a couple of weeks ago. I think Manulife put it out. But don't quote me on that. The average investor in equities from 2004 to 2024, so a 20-year window, markets did 9 to 10% over that time. What do you think the average investor in Canada did?
-20.
Oh, okay. What about you?
I'm going to say they just were under the average.
Interesting. So we're kind of in the middle. They said between 2 to 4% is what the average equity investor did. Now let's be generous and call it 4%. Mm-hmm. Are you guys familiar with the rule of 72?
Yep.
Yep.
Yes. So essentially, if you take 72 and divide it by the return rate, it'll tell you how long it takes your money to double, right? So 7 is every 10 years, roughly. For 4, you're looking at almost 20 years. So if you had $100,000 in 2004, and you invested it, and you were the average investor, in 2024, you would have had $216,000, $220,000 more, but not good, right? If you had stuck in the market, we'll call it 10%. You would have gone from 200 to almost $700,000. Right? So why did the average investor have such terrible returns? They panic sold at the wrong moments. They saw something good and got in too late. They're your friend who said, oh, dude, this crypto is going to change the world. And I bought it and then they lost all their money, and then they said, hey, actually, it's this thing. You know that guy, right?
Oh, for sure.
So
yeah.
It's probably on Reddit.
Now, not every investor is like that. Again, we're talking about the average, but the value that we bring to our clients is making sure they understand, like, we're talking about a long game. We're talking, for most people, 20 to 40 years of accumulating, and then another 20 to 30 years of making sure that pot survives, right? So making sure that when the markets are crazy like they are right now, there's a war that could be happening, could not be happening. And there's another war that's been happening for a couple of years that we've forgotten about. In the midst of all of that, are we staying on task? Are we staying focused? Are we still invested for your situation? Make sure that your goals are going to be achieved, right? And so that's where we make sure you're getting that market, as opposed to being the average investor falling behind and saying, oh, I thought I did good and I don't know where it all went. Right.
Yeah.
So that's on the investment side. And the other side is the insurance side, which is how do we provide for our families in the event that we don't get to do all the things that we assume we're going to be able to do. Right. Mm-hmm. So there's life insurance, which is the one most people think of. There's also disability insurance, which is for you guys and for most people listening to this podcast, you guys have specialized skills or trades, abilities that you've built up over years. If you had an injury that didn't kill you, but you could no longer
use that specialized knowledge.
Yeah, exactly. So you go from, I make 120 a year as a plumber to I make 40,000 a year as a Walmart cashier. Like, how can you make sure you've protected yourself from that eventuality so that you can still provide for your family? If you're the business owner, is my business still going to be able to operate if I'm no longer at the helm, able to put in the 40 to 90 hours a week that needed to keep my business running? The disability insurance is there. So those are the kind of two things we look at. And it's fascinating. I hope you guys will indulge me.
Yeah. Let's do it.
For life insurance particularly, a lot of people think when I tell them how much life insurance they should have, they say, what, that's way too much. I'm not even worth that much. And it's not because of, let me take it back. It's because people don't appreciate just how valuable their life is and how much money they're actually going to make in their life. Right. So what I've done is I've taken a 35-year-old. I like to pretend I'm still 35. I'm not. But
don't take a day over 35.
God bless you. So 35, because retire at 60, 30-year window, right? 35-year-old making $50,000 a year, has got a $400,000 mortgage. Does that actually work? Probably not in today's economy, but put that to the side. They're looking at about $2 million of earnings between now and they retire. Right. Does that mean they need $2 million of insurance? Not necessarily, but that's a big chunk of money that's going to be coming through, right? That you have committed to your family. I'm going to be worth this much to you guys. Right. And in the event that doesn't happen,
we need a wood table, to be honest.
Yeah. Especially for today. I'm going to be doing a lot. We're going to be doing a lot. Maybe I need some of this. In the event that something happens and you're no longer able to provide that value to your family, have you taken the steps, right? So life insurance does that. So for the $50,000 a year person, we're looking at probably needing about $1.5 million of insurance over the next 20 years. Now, the closer you get to retirement, the less, like you have less and less time that you're going to trade for money. So you're not always going to need the 1.5, but it's less than the 2. It's still a lot more than most people think.
Right.
If we jump that up to $100,000 a year of income, which probably a lot more for people in the trades, closer than 50, right? You're looking at that jump size, $4 million of lifetime earnings about to come through, and you need about $2.5 million of insurance over the next 20 years to replace that. And what that means is I'm looking at the higher of, if you pass away and a lump sum comes in, can we invest that so that it will pay your salary with inflation assumptions until age 65 retirement? Or can I provide the lump sum of your remaining years? Whichever is the lower amount is the one that we would use for your insurance. Right. Which is, I'm in the weeds here, but that's
well, that's interesting. And so the goal would be able to take that lump sum, put it in the market, and achieve the average return of the market.
Yeah, so you're using the average return of the market and using inflation assumptions, and we can move that around. If you're like, and I don't think it's going to be 8%, I think it's going to be 6%. Great, I can model that at 6. I think inflation is going to be 3. Great, I can model it at 3. Whatever your comfort is, because really insurance is about comfort that I provided for my family. So based on those assumptions, because we have to make assumptions,
Absolutely.
we would look and say, this is how much insurance you should have, right? And that's on the life insurance side. And fine, I just did 150 for fun. So you go from 50,000, 2 million, 100,000, 4 million, 150.
6 million.
Yes, 6 million, right? And then 3.5 million of insurance you would need over the next 20 years. And then it kind of drops off in the last 10. So
okay,
you might listen to that and say, okay, so for every $50,000 of income, I need about 1.5 million of insurance. And the answer is no. This is specifically looking at a 35-year-old earning that income who wants to retire at 65. Every instance is different. There is no rule of thumb for insurance. It's all about making sure that this is for someone who has a $400,000 mortgage. Maybe you don't have a mortgage. Maybe you have $2 million of business debt. Like, everyone is different, but working with us, what we do is make sure that your needs are adequately met in the most cost-effective way possible so that you're getting the value that you need, the peace of mind that you need. So that's on the risk mitigation side. We'll talk a bit more probably later on about our retirement and estate planning, but essentially when it comes to building up doing your investments, we're talking about what's the best return for the risk that you're willing to take. When it comes to retirement, we're saying, how can we make sure that this will last for the rest of it, right? There's different strategies. And what we're also looking at is there's going to be a final tax bill. We've pushed it off, we deferred it. There's going to come a time where the final spouse dies and all that money, if it's still registered monies, that's going to have to come out. If you have like $1 million in your RSP and you pass away, that's got to come out. The government says that's income in that year. So that's $1 million of income. What's the tax on that? North of 500,000, right?
Yep.
So we did all that work, and then you got your kids, and you say, I got $1 million. I want 500 for Jimmy and 500 for Sally. Well, not quite. I mean, it's still good, but these are the problems that are coming that we always want to be addressing. And the sooner we can address it, the more likely we're going to have better outcomes.
So, Jonny, before you continue, how do we avoid paying taxes?
Well, they're
just the broadly speaking, within the confines of the rules that exist, right?
Or within the confines of the rules that you can
that exist.
Yeah, sure,
yeah.
It's an interesting. I'll get to that. So there's the way the TFSA has evolved over the years. For most people starting out today, it may not actually be prudent to put money into an RSP if they have a limited amount of money at their disposal. Like, if you think of a TFSA, this year the government gave you $7,000 of room. If you wanted to do that on a monthly, so at the end of the year you did $7,000, you're looking at $580 a month. Now, I don't know how much you guys are personally putting away towards retirement, but for most people kind of starting out, they don't have $600 a month extra to be kind of stuffing away. And so for a lot of people, the TFSA room could be as high as $109,000 right now, and they might have $5,000, they might have $20,000,
right? Because
they haven't actually been able to keep up with what the government's giving them, right? But over the long term, as long as the government keeps putting that in, there's a lot of people that are going to have a tax-free retirement because they would have built all of their wealth inside the TFSA, and the money that comes out is tax-free,
right?
So that's your kids, my kids. But the question is, what about us? What about now? There are strategies, there are options, there are tools, and there's always trade-offs. One of the things we have to, and I'm glad you brought this up, one of the things we have to be aware of is sometimes you're going to be better off paying the taxes than building a structure that's really complicated that says, okay, technically I paid less tax, but my return, my max value return is lower.
So instead of paying the government, you pay a consultant to build the structure.
Yes. Right. And I'm the consultant that builds the structure. Right. So like, it's not good for me for business to say that. That's if it's not been structured properly, right? There's a lot of salespeople out there who want to say, you should do this. Like, I have a hammer, everything's a nail, right?
Right.
And so if you talk about corporately owned life insurance, or you're talking about individual pension plans, there's different structures out there, and they'll say, this is the best, and you just do it like this. And then if it's not set up properly, you're relying on that, and then you come out and it doesn't do what you thought it was going to do, and you're paying tax that you didn't think you were going to pay. or you're not prepared for legislation changes that could affect it, and it can get really messy. But that doesn't mean we shouldn't look to take advantage of the existing tools the government's given us to minimize taxes as much as we can.
Yeah, and I think the philosophy that I think most business owners is pay as little as possible, as late as possible.
Yes.
Right?
Yes.
There's a time value of money, and I want to make sure that, okay, I know I have to pay tax at some point. I want it to be the smallest legal amount to pay.
Yes.
And I want to do it as late as possible.
When the dollar's worth the least.
Right.
Yeah, for sure.
Yeah.
And so I want to circle back a little bit here.
Yeah.
And if we go back to kind of, I think a lot of people now in this day and age in the labor market are like, hey, I want to make sure that if I'm going to go trade my time for money for someone else's company,
yes,
I have health benefits or I have retirement benefits.
Right.
What advice would you provide generally to the business owner who's looking at that kind of scenario? Like, oh, more and more of my competitors, for example, are offering benefits. How do I know what works well for us? Or am I in an industry that does offer it? Or, tell us a little bit about the benefit plans.
Okay. Yeah, that's good. Good. So I think I speak to business owners as part of my day job. And a lot of times when we talk about benefits, they'll say something like, you're just throwing money away, right? I pay for benefits. My guys don't use them.
Right.
And I paid for access and then they never got it. Or they'll say benefits just means I got to spend more money and then the costs are going to get jacked up. And then now I'm locked into this thing and it's going to cost me. It's going to cost me is kind of what I hear. Which makes sense. Like you are looking at right now, I don't do benefits. And do benefits cost $0? No, it's going to cost something. The question that we try to educate is what is the value that you derive as the business owner, both from an absolute cost perspective, but also from your employee health and wellness and retention kind of things. And those are nebulous, and you can't say like, oh, retention is up 17%. It's not something you can promise or guarantee or anything, but I will tell you, when I was working with a salaried employee and they have a group RSP where their employer matches them 2%, that's better than what they can do investing with me. I don't like it. I say, if you limit it, you've matched that first. If you have leftover money, then we'll talk. That's first priority.
Right.
And the basic math for that is we talk about the rule of 72. When the matching is 100% return right away. You've done your first doubling.
Right.
So that can be the difference of $1 ending up being worth $8 or 16 or 32 or 64, depending on how many times it's doubled. So getting that first double off the hop is powerful. Even if they could have taken that money and put $2 in instead of $1, like the psychology of it's different.
Sure. Yeah.
And you can make it sound really attractive. So that if you have a competitor who's offering that and you're not offering that, you might be looking and saying, well, what's that going to cost me? And so to go back and say, like, what? We'll look at the business owner perspective first, and then we can talk about the individual perspective. For retirement, there's really two kind of main tools you have. You can do a group kind of retirement plan, or you can do a deferred profit sharing plan. Have you heard of this before?
A DPSP?
Yes. And I love these for business owners because it answers some of those objections, which is, I don't want to be locked into spending, like my business lost $30,000 and I got to pay bonuses. What's going on? Right. With a deferred profit sharing plan, you're saying in a year that we had profit, a portion of that gets allocated to, I got my managers get this cut, my line get this cut, and then the average Joe gets this cut, right? In the good years, great. In the bad years, sorry, there's nothing, but let's buckle up so that you can get the money next year. Now they're motivated, right? In addition to that, you can set it up so that it invests over up to 2 years, which essentially means I gave you $33,000, right?
Yep.
It can be, if you leave the company within the 2 years, that can come back into the company. It's not yours. So there's a retention kind of thing where if you have your good guys stuck with you through the lean times, now you got a good time. Now they're thinking, I'm going to jump ship to big box A, or I'm going to start my own company. There's a little bit of friction. Friction. There's more friction that you've put in. There's value that you've added, and there's friction for them leaving. right? So double. And the other thing about the deferred profit sharing plan that I really love is that because the CRA considers that as a pension instead of earned income, there's no CPP that you have to do on your side, which is almost 6%. There's no EI. There's no WSIB. There's no, if you have payroll over $1 million, you have the EHT, right?
Employer health tax. Sorry.
Yes, employer health tax.
We got to get out of acronyms.
Oh, my apologies.
No.
Yeah. But there's all of those costs don't apply because it's a pension and it's not employment income. So you look at over your entire payroll and you wanted to put in $20,000 that would be split between your company. If you were to do that as payroll, you're looking at closer to $30,000 that it would actually cost you.
Right.
Whereas I can put $20,000 into the deferred profit sharing plan. In a year where I make money, they get some of it. In a year I don't get money, they don't get any of it, and I can lock it in for 2 years. Right. It's so powerful.
Yeah, that's pretty.
Right?
I didn't know about that.
Yeah, it's because it's all this information is siloed. Either like you researched it one night, or like an influencer, you were scrolling and then someone started talking about it, right?
Or you're listening to the
SCHPA podcast.
Yeah.
But I think that's if we go back to the business owner side of things, hey, we're busy running a business sometimes, and we want to make the right decisions and we want to make sure we're doing things right, but we also are running around running the business, and sometimes these are conversations that you don't necessarily feel like you have the time or the capacity to have, and you need some help.
Right. So that's where we love partnering with business owners, because when we talk about doing any kind of financial planning, a lot of people think like it's discipline. It's like working out, where I got to show up every day. I got to do my workout. I got to eat every meal right. Whereas financial planning, if it's done right, we sit down, we do the work with you. It's set up. We put the structures in place. Yeah. Now I can manage that for you. You just have to keep making enough money to fund it, right? Which is what you're trying to do anyhow.
Yeah, right. So now you're protecting yourself for the future.
Yes.
You set it up. You make sure you've got the right assumptions. You're making sure you understand what your lifestyle looks like and what lifestyle you want to maintain once you retire. And if you can do that, then it's almost, I'm going to say, set it and forget it, in the sense that you've got the structure set up. Now you just got to do the hard part, which is making the money to fund it.
Yeah.
How frequently do you want your business owner clients to meet with you, or what do you think is necessary?
When we're first setting things up, we're probably going to meet anywhere from like every month to every 2 months over kind of the first year. Once we've done that, it can be annual, it can be quarterly, it can be biannual, whatever. It depends on the scope of the work that we've done for you. And some of it can even be, if you're the business owner, you signed off on everything, and now you have your operations manager, like we can liaise with them, and then they'll give you the 2-minute summary of the hour meeting that we had, right? So it doesn't have to take a lot of your time up. You just have to be intentional at the beginning, be willing to that initial time investment, and trust that setting up right structures will benefit. Those benefits will compound over time, right? Everything in life, compound interest, working out, eating habits, finances, everything that we do, right? You guys are parents, right? The decisions that we make with our kids, every time it's when we think of good decision versus bad decision, right? It's not like we start at neutral where the weight of all other choices are behind it. So if I say, I don't eat well, I'm going to start eating well, and it didn't work, well, that's because I have 5 years worth of bad choices that I'm having to push against just to get to neutral to then start building positive habits, right? The sooner we can start making those good choices and reinforcing them, whether it's parenting, whether it's financial planning, whether it's eating right, or whatever it is for you, the better off you're going to be in the long term. Absolutely.
The best time to start was yesterday. The second best time to start is today.
Yes. I can't tell you the amount of times I talk to somebody and they say, I wish I had met you 20 years ago.
Right.
And then they walk away and don't do business with me.
Right.
And I say, in 20 years,
you're going to be doing the same
thing. You're going to be looking back at today, right?
Yeah.
It's never too late, but it's a lot better earlier. It's a lot better earlier.
For sure.
So on the group retirement side, I think that was a good enough overlay from the business owner's perspective. From an employee perspective, kind of touched on already, but having that matching, or having that sense of, I worked my butt off and the company did well and I get a piece of that. That's a powerful, I left the job early in my career. I was working for a promotional materials company. And I landed this $2 million client. I did all the work. They worked for Procter & Gamble and it was like employee gift. And I worked my butt off. And at the end of it, I got a handshake and pizza party. I was like, what are we doing?
Right.
I don't feel motivated to work so hard to get that again. Now I have my intrinsic motivation to do well, but there was no, like, we weren't pulling in the same direction. But if there had been a profit sharing thing set up where I was like, hey, congratulations.
Yeah, here's your
I'm landing 2 of those next year.
Right.
I'm landing, right. So to be aligned, to be getting that positive reinforcement from work is valuable to employees. And like, I can't tell you the number of clients who are like, I won't leave this job because of the benefits, because of, and whether it's health benefits or retirement.
Yeah.
It is powerful. It weighs on people. Once they have it, it's hard to give it up.
Yeah. So if you were, so from the perspective of an employee, potential employee, what would your advice be? Look for a job that gives you.
I mean, it's total compensation at the end of the day, right?
Okay.
A $45,000 a year employment that gives you like killer benefits, like a government job, right? Might be worth more to your family. That might be the comfort money and the comfort stability that allows you to have the other spouse go and be an entrepreneur and say like, we're not like, eventually we're going to do so well. So now I'm thinking couples instead of individual here, but I think you have to look at total compensation, and you need to understand, like, if an employer is offering a deferred profit sharing plan, you need to know that there could be some golden handcuffs, right? There could be some limitations on that.
Sure.
And the other thing about group retirement benefits is you have to sign up for that. That's not just, they don't just do it for you, right? The number of people I've talked to was like, oh yeah, my employer does it. And then we look at a pay stub and it says, but you're not.
Right. You're not signed up
and
for
they've been there 5 years.
Yeah.
Oh, wow.
Right.
And so that's potentially let's say it's a 2% match.
Yeah.
And they've missed out on, their first doubling automatically. And they're all getting close to their second doubling.
Getting to the second, right. So correctable, but certainly you want to make sure that you're using everything that's available to you. And that leads us to, I guess, the health benefit side of it. Mm-hmm. Similar kind of deal. A lot of people, when they think about health benefits, they think of what we would call experience-rated plans. And simply what that means is the cost of the plan is entirely based on your company and the way that your company used those benefits. So to start off, they want to get you in the door so they're going to give you a good deal. And maybe you've never offered benefits before. Now your guys have $500 a year of massage. And every single person uses $500 a year of massage. Well, now you've spent more than they brought in premiums. They're not in the business of losing money. So they jack up the cost. And then you say, whoa, bait and switch. And you get upset that nobody's happy, right? So that's what a lot of people think of when they think benefits. And so unless you have a group of probably 30 to 40 people and you can kind of stabilize across, that's probably, you're going to have a bad time most times going that route. The other route you can go is kind of a pooled benefits. So like the chamber benefits package would be, they have everyone to get signed up to one group and your costs are relatively stable year over year. They go up every year because...
But there's some cost certainty there.
There's cost certainty,
because you're spreading the insurer,
yes,
I say, is spreading their risk over a larger number of people.
Yes.
So the factor of one person using all of their massage and all of their physio and all of their therapy isn't going to lead to a huge increase on the pool itself.
Yes. And so if you're going from no benefits to going into benefits and you think your employees are going to jump at it, especially if they've got like wife and kids and it passes on to them, a pooled plan is definitely going to be a smoother ride. But the other option that most people don't actually even think about, because we don't get compensated very well to talk about it, is the health spending plan. Have you heard of health spending accounts? It's
a health spending account. And yes, I offer it.
Yes. it's killer. It's so good, right?
Yeah, absolutely.
From the employer side and the employee side.
Yeah.
From the employer side, essentially, it's a fixed amount of money that you would say, let's call it $2,000 for this class of employee. And you say, over the year, you can make qualified health spending, so like a chiropractor or therapist or any number of things, and you can use up to $2,000. And then if you go over that, you run out of money. If you don't use it, well, then you can either set it up that a portion of that gets rolled over to the next year, or you could say it disappears, it goes off the shelf, right? From an employer perspective, why is that so key?
That it doesn't carry over?
Well, the reason why it's so great, and you're probably already thinking this, is that I've capped my costs. I will not spend anything more than what I've committed to my employees over there any given year, right? Because if every single person uses the whole amount, that's as high as I spend. But if they don't use it, it doesn't cost me anything, right? So I don't have to worry about providing access to benefits that my employee's not going to use. It's like $100 a month for my employee, and like it's just threw water down the drain, right? Don't have to worry about that because this is a pay-as-you-use capped program. You can pair that with a deferred profit sharing plan. You combine those, not like they're not actually combined, like just organized together, so that you cap your benefit spending in a way that is predictable and in a way that will still reward your employees, right? So you can say money that you put into the health spending plan, like category, at the end of the year, only $5,000 of the $40,000 got spent. That's $35,000 more to the company bottom line. If that pushes into the profit, then some of that could be reallocated towards the deferred profit sharing plan. Right?
You could budget it in at the beginning forecast.
Now,
the full
you cannot tie them together, but that is, in reality, that is how they work, right?
No, you could guarantee some health protections and also incentivize high performance within the organization.
From the employee side, what I've seen is some people love to get massages, so they actually want to spend their whole $2,000 on massages. Whereas in the other benefit plans, it's like you get capped at $500 and you're going to not use and now you're out of pocket. Whereas on this way, it's like, no, I would like a massage every 2 weeks and I'm going to spend my massage money every 2 weeks and I'm happy. Whereas employee B might be really interested in orthodontics or dental work or something, and they can then use those funds towards what's important to them. So there's some flexibility there.
I actually like that quite a lot
for the employees.
If you have like coverage for your eyes or something and you don't need glasses.
You might not need glasses. Like I say thank you. Every 2 years I get my glasses done. Right. But it's that flexibility. And the other cool thing for business owners is you get to tap into this as well. So you can run all of your health expense costs without having to pay CPP, EI, WSIB, the employee health tax. Like none of that. You get access to more of the capital that you built up inside the corporation to pay for stuff that you have to pay for anyways. Even if you have it's just you're a solo entrepreneur who's incorporated. Like it's a powerful tool that you should be using to run your healthcare costs through.
So if we break it out into layman's terms, what typically happens if you don't have something like this in place, you're the owner, the company's made money, you have to pay yourself out money. So there's corporate taxes involved, there's withholding taxes withheld, and then your after-tax dollars are used to pay for that massage or that therapy or that dental treatment. Whereas in this case, we're actually having a deduction at the corporate level, getting the same access to the benefits and not having to pay personal taxes on that income.
It is so powerful for personal use and also for your employees. Now, it's not perfect. One of the big drawbacks that you have with health spending accounts is if you have an employee that needs prescriptions, for example, prescription medication, you don't have benefit coverage for that, right? So if it's a very expensive prescription that comes through, or they're dealing with some health stuff, they're going to chew through the $2,000 like that.
Right? Yeah, absolutely.
And so again,
that's kind of why it's there, though. I mean, like qualitatively speaking, like you're offering it so that in the case of somebody needs $2,000 worth of assistance, they get it, and then it can get. I think that's a worthwhile trade-off.
So you can also have like blended plans where you have your experience plan plus a health spending account, like paired together. So you can do mixing and matching. But for most, I would say less than 10 employees, or even like up to 30, like if you say health spending plans for me, it's powerful. And like, how long have you guys been using it?
I think we're into year 2 now,
right,
after not having anything.
Yes.
So this was like a new thing where it's like, hey, the company wants to invest in you.
Yes.
And we see a change in the market, and we want to make sure that, we care about you, and
yes,
here's flexibility for you.
Yeah.
We went from, is a cautious toe into the water of offering benefits. We also offer a DPSP matching program. So we've got the two.
Okay.
We're ahead of the game, it sounds like.
Yeah.
So I'm happy. But it was, hey, like, we want to make sure that you're also taking care of yourself from a health perspective,
yes,
but also incentivizing you to put money away for retirement.
Yes.
And so that from that matching perspective, I think that's a big thing, because having your employees starting to take care of themselves for their retirement is actually, like, for me, it's a weight off my shoulders.
Right.
It's like they're putting money away to take care of themselves.
Yeah.
So they'll be ready to retire when they're ready to retire. Right?
Yeah.
Especially when you look at in the trades, like for a lot of guys, they can't do until 65.
Yeah.
Right. Certainly, maybe they are one of the good ones that transition into team lead to management, or they own their own place. But for a lot of guys, like, it's a ticking time bomb, right?
Yeah.
And so to properly care for those employees and say, like, you got to start on this now. One of the things we do, I didn't really talk about it before, was we do like education stuff. So if you have employees and you say, we're putting in a health spending account, we're putting in the deferred profit sharing plan, you don't have to, like, you eloquently talk about the value of it, but you don't have to. We can come in and we could send an email, we can do a seminar, like whatever you guys want. And like, education is so helpful. People understanding, like, what are the things I have access to, and why should I be taking advantage of it? I didn't do my first massage till I was 35.
Right.
Because I don't need it. Like, I was playing sports, everything's fine. And then my wife was like, go on dinner. I was like, oh.
I'm spending my $2,000 on massage.
So like, I was on this side of the, like, I have to overcome all this weight of, you don't need it, to get to allowing myself to use these benefits that I have access to.
Yeah.
Yeah.
Yeah, I think it's a powerful tool. And I think it's one of those things. And, one of our questions is going to be like, what, financial information would you give to tradespeople and to business owners today? I mean, part of it is have the conversation.
Yes.
Where are you today?
Yes.
As business owners, generally, from the business owners that I know, we care about our employees and we have a good idea of what they need, but it's also like, how do we structure it so that they can get what they need?
Yes.
And we know that we're protected.
Well,
right?
Exactly. Because you can't offer them financial advice necessarily without having some level of liability.
Absolutely.
Yeah. And you don't want to be the person who, even if you got rid of the liability, gave bad advice. Like, I've told my friends to buy stocks at tank. And I'm just like, sorry, dude. That was my bad.
That's a note to myself. Don't take stock advice from Dave.
Yeah, no, don't.
I think we've had a great conversation. There's a lot of good things, and I think we could have this conversation for a couple of hours, because we scratched the surface on a tax-free savings account at TFSA, but there's, the RRSP, registered retirement savings plan. There's lots of different tools that are available. But and we've talked about the rule of 72. We've talked about average returns of Canadians in the market, which is not great.
No.
They're only at 4%.
Yeah.
When you could buy just an ETF, which is a fund that monitors the S&P 500, for example, and just get the market return with little risk.
Yeah.
What's something in the financial world that is boring on paper, but actually has a huge impact? Aside from all the things we've already talked about in this short period of time.
We also mentioned total compensation.
And that's really important for employees to understand what that means, right? Because you don't want to discount some of the other things that are not necessarily non-financial, but aren't directly hitting your bank account.
Yeah. I think humans as general, we understand linear math pretty straightforward, but like compounding just really, like, we don't understand it, because if we did, our behavior as a species would be different.
Right.
And so when I sit down with a younger client, say 25, got their first grown-up job, and they're saying, what do I do for the next 40 years? What I tell them is, the planning we're doing today is not you're not going to see over the first 10, 20 years. You're not going to be like, oh, I made killer returns and I'm rich, right? I start at 20 so that at 65, I got to double 8 times instead of 7 times, right? You will always have the first 20 years of pain where most of the contributions you put into your investments
are principal.
Exactly. And so you're always going to go through the pain. The question is, how quickly can I get that pain out of the way? And so if someone comes to me and says, I want to invest in the market, and then after a year, they're like, how come it was only 7% instead of 12%? It's one thing where it's like, okay, like we're looking at the wrong thing. You have to keep in mind that every year you take a pain here that you didn't start is a year of massive growth at the end that you never got, right? You will always do the pain. It's just how much gain are you going to get yourself? So that would be for everybody. It's the same in running a business, the same in, right? Like when you say, when do I bring on my first employee? Like for some people, they never do. It's just, they were comfortable with this. But like if you start that process early, you're going to have all the pains of figuring out how to manage people. But the longer you do that, the more you're going to be able to have a business where eventually you can step away and it keeps running and it's a cash flow for you.
Amazing.
Yeah.
The rule of 72 in this compounding, like the exponential, is interesting to think about. Like this is something that I thought about, and it took me a long time because I always apply the rule of 72 to the initial investment. So if I put $1,000 in, I get 7.2% interest. It's going to take 10 years for that 1,000.
Yeah.
Okay, well, but I put $1,000 in every year for the 10 years, achieving the same rate. So the first year is 1,000, second year up 1,100, say, and then, let's say 1,100.
Yep.
And then but you're actually you're putting another grand of principal. So you have 2,100. So the next year is 23?
Yeah. 2250.
Yeah, 2250, right? And but you put 1,000 in, and then so on and so forth. And so like by being consistently applying this principle, you're resetting that 72. Like it grows very fast. It can grow really fast.
Yeah.
And it's exciting.
It does. And the other thing too is that you have to do that pain. Like once you get to about $100,000, that is going to be significant. Like 100 will grow to 2, grow to 4 to 8 to 1.6 million, right? So once you get to there, then you can, like, you're saving. You don't have to save like $1,000 a month every month for the rest of your life. Like we can get to a point where we say we've done the hard work and now it's going to start working. At a certain point, adding another $1,000 is going to do nothing, right? That $1,000 is only going to double twice. So you're saying, I'd rather take that and make sure that my kid plays hockey, right?
Absolutely.
And you should. Part of what we do is we taking care of today's Dave all the way through to retirement Dave and every Dave iteration in between, right? Does you no good to eat ramen and peanut butter and jam sandwiches and like scrimp and save and send everything to retirement. So when you get to 65 or 64, you've done a good job. And then you retired and you got diabetes and you can't play with the grandkids and it costs too much in travel insurance to go anywhere. Like, no good, you got to take care of that person too. And so we have to have balance in life. I'm not going to be the guy that says, give me all your money and let's invest it and you figure it out. I will say make more money and then like you can make your way out of most problems. But you always have to have that balance. And life is about balances. And right, if you don't have a plan right now, well, then you're balancing on the edge of the cliff, just kind of hoping things are going to work out. And maybe they will. But
so maybe that's the boring thing is the plan.
And again, you can set it up and then let it do the work for you, right?
Yeah, that's awesome. That's
fantastic.
Good.
Well, I think Dave, we nailed it.
I think we nailed it.
And we're right on time too.
Okay.
Prime time financial. Come on, I'm trying really hard. Right over his head.
I'm hungry.
Jonny, well, thank you so much for coming in. I think it'd be worthwhile to spend some more time with you again in the future and get in a little bit maybe deeper on some issues. But there's a whole financial world that I think a lot of business owners need advice on. And this is not that this was advice, but it's information to get the ball rolling to make those decisions so that their money starts paying them down the road.
I only went through one page of my notes.
Fantastic.
I'll have to come back
All right.
I'm going to rival the mayor.
Okay.
Yeah, let's do it. Yeah, you'll be our VP.
That's amazing.
Yeah.
Thank you so
Great.
much,
Thank
Jonny.
you, Jonny.
Yeah.
And if you would like to join the podcast as a guest, or if you'd like to sponsor an episode, please reach out to podcast@schba.ca. Jonny, thanks again. It was an absolute pleasure.
Glad to make it.